What's going on, everybody, and welcome back to the channel. In today's video, I'm going to be covering a topic that so many of you guys have requested. I've getting DMs, comments, messages, so many questions about supply and demand. How should you be using supply and demand for your trading? And yes, it is a super important topic, and it's actually a topic I don't think I've ever really talked about too much on the channel. But I'm excited for you guys to bring it to you and explain to you really what supply and demand is. So make sure you watch this whole video because it's going to be super important that you watch this and you add these techniques into your strategy. So if you find value throughout this whole video, make sure you hit the subscribe button, like, and comment to what you want me to cover next. Let's first break out what is supply and demand. And the simplest way to explain this is to think about basic economics concepts. When there's too much supply? When there's too much supply, you're expected of price with certain asset or commodity or good to come down because there's just too much of it for a amount of people that actually want it. So whenever you hit the supply level, you're kind of expecting a pullback or a retracement. While the opposite is demand. Whenever there is demand of a certain object or asset in this case, you're expecting the price to go up because people are going to start buying it. Essentially what supply and demand is, whenever a stock price or an asset price hits a certain level, is expected to go down or lower. We also have to understand that supply and demand are a lot of times used by banks and institutional investors to move large amount of money. You have to think about it. They have billions of dollars they need to invest in the markets, and they need the best possible price. So they have a ton of orders waiting at key levels for them to buy up or sell a certain asset. Think about it, myself, you, all the small retail investors don't move the market at all. We're just going along for a ride of these big institutions moving the markets and us trying to catch a little piece of that. So there are two main ways that I like to spot out supply and demand zone. One is a V-shaped move. That means a quick move to the up or to the downside. So let's say price goes down, it quickly gets bought up and creates a V-shaped recovery to the upside. That means there's a ton of orders waiting at that level that bought up the price and push it up very quickly. And vice versa. You could have gone up and quickly came right back down because there's a ton of orders, a ton of institutional orders waiting there to sell the price and bring it back down. This is the first way I like to look for supply and demand. Second way is look for areas of consolidation. So an area of balance in the market is where the price isn't really going up or down that much, staying within a range where buyers and sellers aren't really fighting too much over. This is what you call balance. The supply and demand is equal, but then the supply and demand is broken to a level or the other. Now that means an impulsive move up or to the downside. Now, if you go back, the area consolidation will be considered supply and demand area. But how do we draw out the supply and demand area with a V-shape or recovery? So let's first talk about that one. That one I like to look for big red or green candles that have small wicks. So then I will draw the supply and demand area from that bottom of that wick to the first swing high or the first green candle that close to the top side. So let me show you guys in the chart how that will look. I have here one of my favorite stocks, which would be Tesla. This is a 45-minute time frame. And while I'm on the time frame subject, let me tell you guys that supply and demand works on all time frames. You can use it in a 5-minute, 45-minute, hourly, daily, weekly. It doesn't really matter. Just make sure you stick to that time frame through the whole time. So I like to use my rectangular tool to draw a supply and demand. So as you guys can see here, the price wicked up and you have a big red candle with a very small wick. So I will take it and I will draw it from here and move it up to that swing high, which will be that green candle from the top of my red candle, and bring it across all the way across. And imagine this just here never happened. So then you have an impulsive move to the downside, which we see here. And whenever price goes back up and it re-enters this supply area, as you guys can see, it gets quickly sold off and comes down. So this can be used to when you're looking for the supply and demand area. Again, now if you're looking for when these big red candles kind of happen right here, you could draw it once, to make sure it happens again. As you guys can see, you have this green candle here, and this is not a red candle, but this is the latest swing high because you had a gap down here. So you would take it, you would draw it, and you go to the very top of it. And again, you can see there's a supply area there. The price went up, retested it, and came down crashing and selling it off. Well, now that we talked about how to find the quick moves down supply and demand zone, how could you use the consolidation areas as supply and demand? Now, this is a secondary strategy that I don't like to use as much. It is still a really great strategy to know where major orders may be, but I do prefer using the quick move ups for my day trades. But I will show you guys both ways. So this will show the whole zone, and the whole way that I like to draw this is draw from the bottom of the consolidation area. As you guys can see here, we have the S&P 500 SPX on a 15-minute time frame all the way to the swing high of that consolidation zone. So from the very bottom to the low, you draw that across. So you can see as price went back into that zone, try to fake a breakout here, but eventually was sold off here for much lower. And you could have started an entry position into the zone as for short puts, and you could have had a stop loss a little bit above this. As you can see here, there was a small chance you could have gotten faked out here, but maybe if you enter up here early, you could have taken a little bit of profit here. But there was a potential to potentially get stopped out. So my recommendation for you guys is to give it a little bit of room, because a lot of times with this supply and demand zone, the market makers understand there's people maybe trading it and quick do a little liquidity grab before bring it straight back down. So the main reason I like supply and demand zone is because you can have a very defined risk to reward and a very defined position where to put your stop loss. For example, in this example, you could have, if you had entered just somewhere in the middle here, let's say you could have had your stop loss above it to about a 1% stop loss, which is a very tight stop loss, to have a potential first profit target at the bottom of this gap right here, where you had some support at 1.8% gain. So that's about a ratio of 1.7, but eventually this could have gone all the way down to what another support area could have been, which is this area right here, about 3%, which would have been a risk reward of 1 to 2.89, and eventually could have given you much lower, which would have been an amazing risk reward of 4.73 or so. So this is how you can see that you define your risk, it defines your rewards, and defines where your stop losses are going to be. And it's a very, very powerful tool to have. Now, this is very similar to another concept that you might be familiar with, which is support and resistance. All people talk about support resistance as areas of catch bounces or rejection. But I feel like supply and demand is a superior, it's a tier above support and resistance, because it gives you a whole area rather than an exact number. So we just talked about potentially fake breakout that we just saw an example of, but with supply and demand, those fake breakouts and those fake breakdowns are much more likely. With supply and demand, you have a whole zone that you can watch for price rejection, so it gives you a lot more information of the certain stock. So I think a combination of both support and resistance, combination with supply and demand, can be very powerful together, and it is a trading strategy that I prefer. These two examples I just gave you on Tesla and SPX are pretty much great examples that you can use to go out there and try it yourself. The best way you're going to be able to do with drawing the zone is just, of course, practice. Draw some of the zones and then go back and see if the day after or whenever the price re-enter the zone, if you saw some rejections or if you saw some breakouts above that area. As always, if you find value in this video, make sure you hit the subscribe button, and if you want to stay around for more educational content, make sure you hit the bell notification so you don't miss any of my future videos. If you want to get all my trades live, and yes, you can just literally not do any work, copy all my trades. I do that every single day in our Discord. We have an over 80% win rate, and yes, I trade every single day. I'm not one of those guys that trades once a week. On average, take 3 to 5 trades easily per day. So come get rich with us, hit the links in the bio, and I'll see you guys in the next video. Peace.